What up? It's your boy, Rusty Russ. Back with that promotional video. Let's go. Let's do this. Alright guys, your boy Rusty Russ. Back with that promotional video, like trying to teach you guys how to trade options. Like right here even. I'm literally gonna teach you my strategy right here for free. Like not even bullshitting you. Like for free. Like I'm not even gonna sell you a course. Like I'm not gonna charge you $700 for RSI. Like I'm not an asshole. But what I am selling are callouts, right? So like this stuff right here is like, it's real hard, guys. You know what I mean? Like I can teach you how to do this and stuff, but I'm like saying in the meantime, like I'm consistently profitable. I'm patient. I'm not greedy. I know my stuff. I look at the chart all day. You know, I got alerts set. I know all the stocks in the market. I read balance sheets. I listen to conference calls. Like, you know, like I do this. I watch out for economic data coming out, and I do the entire thing, guys. So like I'm saying, like in the meantime, while I teach you how to do this this option stuff, because you could easily double your money real quick if you're patient and you follow my rules. But like I'm saying, in the meantime, like I charge $15 a month, 30-day free trial if you give me a 5-star Google review, which you ain't even gotta write anything, just submit that 5 stars. Link in the description, and you know, and you get 30 days free. But basically, I just call out, put credit spreads, and call credit spreads positions. I'll show you that right now. And I'll show you how to analyze the chart and pick a position and where to enter and where to exit. But like I'm saying, like, you know, you just follow, like if you just followed me and do all the trades that I do, like you're gonna make the money that I'm making, and I make money every single week. I'm consistently profitable. I've been doing this for a long time. A little bit about me, guys. My name is Rusty Russ. I was raised in the foster care system in the south side of Tucson. I'm from Arizona. You know, I kind of grinded my way all the way up here. You know, went to school, did all that, got my degree, and now I just do me, guys. And I just make money in the stocks. Like that's what I do now. So all right, let's begin. Okay, guys, right here, if you see this right here, this is my watch list. So basically, my watch list, you can just straight up copy this right here, like pause the video, copy it if you want. Like I'll scroll. But we'll go through it. So this watch list right here, basically. Is pretty much a bunch of stocks and a bunch of sectors in the market. I don't know, I'm not sure if I have all the sectors, but I have a lot of sectors in the market, and I kind of like, I'll look at this entire watch list and I'll try to look at an entry. So the first thing I'll do when I'm looking at a new stock or a stock in general, like I look at the 180-day 4-hour. So for example, this is the S&P 500 in general, and these are candlesticks, right? And this is time, and this is the index price, and this is RSI. I have implied volatility mixed in here on accident. You can ignore that. You know, implied volatility is like way too hard for you to learn right now if you're not a trader. I'll teach you to later. You can just hit me up in the Discord and ask me, and I'll just tell you. But anyways, so RSI, if this line right here, don't worry about the white one. If this line right here is low, it says that the stock is undervalued sometimes, and if it's real high right here, it says that the stock might fall. But like, look at this, like it didn't fall. This is, so it's just sometimes, and this is MACD. So when this line right here crosses from below to above, I even put like a little arrow up here so you know, or it's right here, boom. It signals that this stock could go up, right? And this is money flow index, so it's just like RSI pretty much, except it's volume related. And if this is low and this is about to cross, and the RSI is low, then that says like this could go up. This is the S&P 500 in general. We don't trade the S&P 500. This is a NASDAQ, right? But let's say like, let me find something good. But anyway, so I look at the 180-day 4-hour, see what it's doing. But usually I'll go to the 20-day 1 hour, yeah? And like, I'll wait for like this to happen. I'll wait for the stock, this is the Apple, by the way. I'll wait for the stock to trade at the bottom of the range, like right here. Or like right here, boom, 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 boom. Right? And I'll wait for that RSI to be low, MACD about to cross, money flow low, right? And then I'll put, so right there, bang, so anywhere right here, and then I'll enter a put credit spread, and I'll put my strikes like 145, 146, and I'll let the stock rise. And as the stock rises, it affects the options that we just sold, or bought. If you don't know what that means, it's sold because it's we're selling premium. I'll tell you about that right now. But basically, as the stock rises and we set our expirations maybe 2 or 3 weeks out, we can probably get 20% out of that stock, out of that position, and we just close it for 20%. And we get like 8 positions at a time, 8 to 12 positions at a time, and then we manage risk. If we need to, usually like the majority of my trades win, and you give yourself enough time to be right. Like if Apple didn't do this that day, it just kind of went sideways, and then it slowly rose again. Like eventually it'll go back up because it's Apple. So that's what we do, and then additionally we do what are called call credit spreads, which is the opposite. Like again, we're doing the opposite. This is really high. This is about to cross, and the money flow is way too high. But this is a really good company. Call credit spreads are dangerous because the market is mostly bullish. But like right now, the Federal Reserve is about to taper asset purchases, and there's a bunch of negative news. So the market could definitely come down. So I just put my strikes up here, and as long as it stays below and crashes, we can get 20% real quick because of the way the options work. Because AMC don't trade it. AMD, which is Amazon. Market's been having a real tough time. It's August 2021 when I did this video. Caterpillar. So that's basically how you do the charts. Here, let me show you the broker. Alright, so you get a Tastyworks account, guys. You go to tastyworks.com and you have to sign up for it on your computer, right? You can't just download the app on your phone yet. And then you go through the application, and then they'll approve you. You'll get an email, and the next day you fund the account with at least $1,200. And then you can download this application on your computer, and then you download the phone app too. Okay. All right. So we're looking at what, Apple, right? Let's say like we were gonna do the Apple trade, right? I mean, it already went back up. So like, but let's say we were gonna do the Apple trade, right? We did the chart, and it was that moment that we looked at. So we turn this to short. We make sure that says put option go, short put go. Wait, where are you? Wait, no, not option. I lied to you. Hello. No. Okay, so I lied to you. So it needs to say short, put, vertical, and then go. Okay. Some technical difficulties. Okay. Anyways, so short put go, right? Short put vertical go. You under strategies you choose vertical, and then you can just press this little button and hear all the strategies. You got iron condors, straddles, strangles, butterflies, jade lizards, all sort of stuff. But we're doing verticals. So short put vertical, and then you click go. Okay. And this is not Apple. I typed in the wrong one. AAPL. I did it again. I'm not even gonna edit this. Like I don't even care. And I got some already. So let's talk about Amazon. I just got a few. So let's talk about Amazon. Screw it. We did the chart, right? We looked at the chart. We looked at Amazon, right? Okay, we looked at the 20-day. What is this? 20-day 1 hour. This is a 20-day 1 hour. We zoomed in. We're like, okay, our side low right here. I mean, MACD crossed over here. So by market open, we're kind of a little bit late. No big deal. And low money flow. Cool. So maybe strikes right here at 3,200 and 3,205, and then you go over here. You go Amazon, short put vertical go, 3,200. What was the price? It's at 3,200, yeah. 3,200, 3,205. So right here is the strikes. Kind of move them over. Maybe 3,200, 3,205 right here, boom. And then you gotta make sure that you get half the width of the credit and spread it. I mean half the width of the spread and credit, this is good enough. And then you get one. And then as the price of the stock moves up, because this is a put credit spread, you'll start to make money. Okay, so that's the order in which you do it. Now, what is a put credit spread? I told you guys this shit is real complicated, guys. Like I'll break this shit down to you, but like your head's about to hurt. Like you can straight up follow me one time, like, and then learn as you go. At least you'll be profitable on the way there, you know. But like if you're trying to learn this, like, all right, cool, keep watching the video. All right, so check it out. Right now this is a put credit spread. So when you've heard of the word puts, if you know anything, like know even a little bit about options, when you hear the word put, you might be thinking to yourself, but wait, you're betting it's gonna go down? No, this is a put credit spread. So when you sell a put, you're betting it's going to go up because the buyer's betting it's going to go down, and you're betting it's going to go up. They're like, I think this stock will be below this price by this date, and you're like, yeah, I'll take your money. And then when they're wrong, you keep their money. Like that's what it means to sell a put. But to sell a put, you need 100 shares. You might be like, Russell, I don't have 100 shares at Amazon. Are you crazy? Like, okay, that's no big deal. You just do short put vertical, right? And what you do is the broker lets you sell 100 shares here, and in this instance, you'll get 60 $6,295 because it's times 100 for this, and then you give a lot of that back to buy this one, right? And the difference between these two means you'll receive a credit, and right here it's marked as max profit, and this puts you in possession of 100 shares, right? So now you're allowed to sell, okay? And then the difference between the strikes is 3,200 and 3,205, so it's a $5 wide, okay? Which means you want to receive half the width of the credit spread, half the width of the spread in credit, which is $250. But you need the other half. The other half, whatever you didn't get in credit, that's how much it costs to enter. So this is a $5 wide. Usually we don't do $5 wides, but this one is like $250. This is your max loss, right? Because this is how much you can lose at the end of the trade if you're wrong. If Amazon goes this way, right? But you don't even need it to go that way, guys. Like, you just need it to go up a little bit, and we take 20%. We're not going to wait till the end of the trade. We never let our options expire. But also, this thing called theta decay. It decays the trade. It helps you as a seller. I'll break that down a little bit. But anyways, so you enter. You have to give them your max loss up front. The broker's like, all right, cool. You receive $250 in credit. We're going to hold on to that, though, because anything can happen between now and 20 days from now. This expires 9/10 specifically, so we need that max loss up front too. So and you'll see that, like, in this instance, since you receive $250 in credit, the max loss is $250. That equals the $5 width, right? It all comes together, guys. So in this instance, you would receive it would cost you $250 to enter, and if you're right, you get your $250 back plus $250 at the end of the trade. If you waited until the 10th and Amazon is anywhere above it's actually $202.50, like that's above your break even. But if you're gonna hold it until expiration, like, you need it to be over here, okay, like 3,300 at least. Like, you need it to be way far away, because what happens on the last day, if it's right here and then it just does this, you'll lose. And then, like, all the days leading up, you were green, you know. So that's why we take our profits immediately, guys. And also, like, I've ran all my trades through a simulator, and 87% of them are profitable when we take profits at 20%. But the profitability goes down the longer you hold the trade. In terms of, like, if you get greedy and, like, every trade you take like 80%, the probability that you'll be right out of all of those trades will be worse. I've done all the math, guys. Like, I've been training this for a long time. Like all these rules were put together specifically for you guys, and for me too. But, like, to make sure that, like, we take greed and emotions completely off the table. You know, you just follow the program and you should be fine. Like, we've done the math on this. But here, check this out. If you're still watching, I mean, you could just straight up follow me. Like, just click the link, follow me. You'll learn as you go. But anyways, let's say, like, we got the 31.85, right, and the 31.90, right, a couple days ago. That's now trading for $190, right? But what if, like, this couple days ago, we received $250 in credit or whatever, right? This one's at 190. That means you can close this trade at 190, and you get the difference between 190 and $250, and you get your money back, your $250 that you put up front, right? So you can just close the trade as the stock market. This is the price of the stock, by the way. The full dot is where the stock is at. So as the stock starts to move up, the credit on the market will start to move down, but you received more, so you just give it back to the market and take your money. But let's say, like, we got like $1,000 worth or something, which is right here, right? And you got like 20%, like, that's $250 in like a day or two, boom. And you manage risk and you diversify. Like, it's no problem, guys. You can make money, you know. I mean, it's not that hard. I mean, it's hard not to be greedy. It's hard to be disciplined. But, like I'm saying, like, maybe just follow me for a little while, and then I'll teach you how to do this, and then we just go from there. I mean, don't bet the farm, though. All right, guys? Like, don't bet the farm, though. Like, for real. Like, let's take it slow, okay? And leave your Roth IRA and your 401k alone. Like, if you have those, like, we're not trading with those, guys. Like don't trade with those. Like, that's your future. Just, like, fund this account with like an extra $1,200 or $2,000 if you got it. Like, that's it. And then, like, we'll learn together. And eventually, like you can be up like 100-200% in like a month or two. Like, easy peasy. You just keep going from there. All right. Okay. All right, guys. Make sure to like, comment, and subscribe. Like you can comment underneath, say what's up. Like on the Facebook post, like, that's fine. Or like on the YouTube, if you're watching this on YouTube, or if you hit that Discord link, like, join me on Discord, guys. Like, click the Discord link, and then like hit me up. My name is Rusty Russ in the chat, and I'll show you how to sign up so we can get started. All right, guys, let's do this. Like, let's get this money though, like for real. All right, guys, that'll be it for me. Deuce.